Hello, I'm Steve Mans with The Books Add Up. The Books Add Up provides tailored bookkeeping solutions for growing businesses because when your books add up, you win. And today we're talking about how to understand your profit and loss. A lot of businesses go crazy looking at the bottom line just to see whether they are green or black. This is a mistake. You're leading yourself down a primrose pasture. I hear a lot of times from clients, why is my profit and loss showing that I'm doing well, but my bank account is not showing the same thing? Well, there are good reasons for that. So several of them have to do with how do you structure your profit and loss. Others have to do with watching the profit and loss and cash flows and doing projections. The first thing that I talk about with clients is what are your costs? Many businesses have not really put a lot of thought into this. And a lot of businesses think that the costs and expenses are synonymous. They are not. Every business is a little bit different, and we would like to talk to our partners about analyzing what is exactly their costs. Costs are those expenditures that you have that directly relate to providing your good or service. An easy example is a manufacturer's example. The costs of building a widget are the materials that you buy to put the widgets together. If you need part A and part B to put together, part A and part B are your costs. Where it's not as easy to understand is services. Does your service require that you have software? Take, for instance, a bookkeeping firm like mine. We utilize many different softwares. All of those things are my costs to deliver the service that I provide. So they are listed among my costs. A cleaning service. Are you watching how much cleaning materials that are going out the door? Can you identify any leakage? Sometimes costs like that are easy to get lost provide a lot of leakage. To understand how to analyze and find these things requires that you look at your P&L often. So, the difference between a cost and an expense. Costs are directly related to the good or service that you are providing. Expenses are the things that cost you to operate the business. Usually, in most businesses, rent is an expense. It's not a cost. But every business is different. I gave an example of a cleaning service. Cleaning materials in a cleaning service are costs. Cleaning materials in a bookkeeping service are expenses. We keep those things separate. Why do we keep them separate? We're going to go into the structure of a profit and loss. Why am I making a big deal about costs? Because the way to understand your profit and loss in the first place is not the bottom line, it is the middle line. What you want to do is analyze your gross profit margin. How do you get your gross profit margin? Everybody's watching revenue. You know income and revenue is at the top. Right below that, you put your costs. And your costs, you want to be at a level percent. So that your gross profit margin, say, is 60%. That means that you have 60% of the revenue that you've earned to utilize for expenses. So, when you identify your costs, you will be able to identify what your gross profit margin is, and you can decide what your gross profit margin needs to be. We'll get into that in a little while. But the way that you price comes from understanding that line. Most times when I see clients, I hear things like, we just need more sales. I want to caution you, that is a trap. More sales is wonderful, but you will never outpace losses. I promise that if you are in a loss situation, more sales is just going to make it worse. How do you understand really what the problem is? First, understand your profit and loss, and that's what we're here for today. I want to discuss with my clients about identifying costs, identifying their gross profit margin line, deciding what they want their gross profit to be, and then pricing. That is how one prices their product or service. and that's how everybody should be doing it. First thing is identify costs. Make it clear what the distinction is between a cost and an expense. This is an early conversation that we have with our clients because we want to be a growth partner. The second thing that we talk about is, okay, now that we understand costs and we know the profit margin that we want, and we have analyzed the market to see where we can price effectively, we need to understand what our other expenses are. Every business has expenses. Every business. You talk about rent, you're going to need operating supplies like office supplies, you're going to need ink, you're going to need paper. These are normal expenses for businesses. Every business has them, every business uses them, and every business has to replace them. What are your replacement costs for your expenses? What we identify is, once we know the costs and we separate them, then what's left is the expenses. We want to come up with a baseline monthly expenditure. We call it overhead expenditures. What is your monthly baseline expenditures? That we talk about dollars, not percents. Dollars in the expenditures generally remain the same. Rent generally doesn't change month to month. So we can get an idea of an approximate average monthly expense. So when we get that overhead number, we can easily say we know our income, we know our profit margin. We just talked about analyzing the cost and the profit margin. How much cash do we need left over after that in order to be able to make our bills and be profitable? The second thing I caution people about here is do not forget you're going to owe tax. Every business will have tax. You're in business to grow a profit. Profit means tax. Get used to it. Get to enjoy it. When you're paying tax, you're making money. Don't think of tax as a bad thing, but don't forget it as an expense. It doesn't show up on your profit and loss, but it will show up on your cash flows. So, when you are analyzing your overhead, what you want to do is to remain vigilant about having enough in the bottom line as a percent of your revenue so that you can afford to pay your tax and afford to pay yourself and afford to keep your business going. Generally, we like to see our clients be at least 10% at the bottom line. 20 is usually the goal. So if you can be at a revenue to gross margin at 60% and then another 30% in the expenses, you're in good shape. But we also want to be able to increase revenue and decrease those expenses. In order to do that, one has to be watching this on a continual basis. The Books Add Up wants to be your growth partner. We are in a position to not only help our clients to organize these things and see trends and make decisions, but we are also in a position to make that information available in real time. This is huge. This is a competitive advantage. When you understand your profit and loss and you are analyzing your profit and loss and you have a growth partner who is working with you to keep that up, you are in a real good position to succeed in business. We have several clients who we took from a 5 or 6 figure revenue to now multi-million-dollar companies. It starts with a conversation about costs versus expenses. Identify your costs, then start talking about your P&L with your growth partner. This is Steve Mans with The Books Add Up. I hope you found this video enjoyable and helpful. If you would like to get in touch with us, feel free to do so. We'd love to help you to see more about this. Remember to like and subscribe. And remember, when the books add up, you win. Thank you very much. I'll see you on the next one.